What's up, folks? Welcome back to the channel. Thank you so much for returning and hope everyone's weeks have been going great. Now, given the title of this video, I assume everyone probably thinks we may talk about how to end up here permanently, which we could get into eventually, but not quite yet in this video. Now, before we get into the content, remember to please like, comment, and subscribe. We haven't been getting any comments so far, so if you could please comment, that would be great, and subscribe to the channel and like. So, and another concept to emphasize in today's video that we'll go over again, as we do in all videos, is that cash loses value. And this applies also to being rich versus not being rich. As we'll get into in this video, people who are not considered rich can only trade their time for a wage, which loses value. And with that being said, to start off, how should we define rich? What would we commonly think of as rich? I pulled some information here. I pulled the definition off Google and then some other information. So rich, according to this definition, is having a great deal of money or assets, wealthy. And then the quote, "Every day the gap between the rich and poor widens." Now, what net worth is considered rich? According to this, Schwab conducted a modern wealth survey in 2021, found an average personal net worth of $1.9 million to be considered wealthy. And on a standard basis, that's the value of assets minus liabilities, also known as what you owe, to add up to that. To continue this, a report from U.S. News and World Report, How the Wealthy Are Defined. Net worth is the sum of an individual's assets. Notice a trend here yet? You've seen the word assets twice. Less liabilities. But individuals with high incomes don't necessarily have a high net worth to match, and the reverse is true as well. And as we'll get into, that's because it's not so much what you make, but it's what you do with what you make. Another quote here. A lot of people who are wealthy in this country are wealthy not because of income, but because they own assets. Trend, huh? They have investments that appreciated, real estate or otherwise. While income funds an individual's lifestyle and day-to-day costs, like that vacation slide you saw in the beginning of the presentation. And hey, obviously we want to get there. Now, continuing the idea of how we define rich, and by the way, just to mention again if I didn't already, some new enhancements to the channel, a wearable mic, which hopefully improves the sound, and some better lighting. So this should be good. Enhancing my own channel, again, so that I can better enhance your life financially. So, continuing this idea of how we define rich, according to the latest data available from the Federal Reserve, and these stats always amuse me and amaze me at the same time, because it's like, really? Like, when I see these, I have to really look twice. The average American household net worth is almost $750,000. Really? On average? Okay, if you say so. And then net worth by age group. And then median and average. Again, notice there's a big difference between median and average. Under 35, 35 to 44. Wow. 45 to 54. Really? And then 55 to 64. These numbers are very interesting, according to the Federal Reserve again. Now I'd like to go into some of the top reasons why the rich, quote unquote, seem to always get richer. The top one that I came up with, because they own assets. Again, notice a trend here. Assets. They own assets, providing the ability for capital to generate a return or capital gain, as you may have heard it referred to, versus non-asset holders who only have their time to trade, as an example, their labor for a wage. So that's why it's so important, if you're going to enhance your life financially and build an asset base and a net worth, you really have to start saving money and owning assets. This is the top and biggest reason why the rich seem to always get richer, it's because they own assets. And to build on that, when you only have a wage to trade, or when you only have your time to trade for wages and you don't own assets, what's going to happen to that wage over time? And we see this in real life all the time. It loses value, right? Further affirming that point. So the second biggest reason that I thought of, the prior point that we made about owning assets creates a cycle, so to speak, where more capital returns reduce or eliminate the need to use labor and time to trade for a return or a wage. Because what happens is that people that start to own more assets and investments that start to appreciate in value, they suddenly realize they don't need to work and they can vacation all the time or own vacation homes that appreciate even more in value and allow them to do the things that they want to do in life. Thus, allowing more resources to funnel into assets which create even more returns on capital. So you see it's kind of like a cycle. A lot of cycles in life we don't want to keep continuing, but this is one that you do for sure. Now, to provide a chart that emphasizes that past point and segues into my next point, what happens is that very often the policies and the way the system works really favor asset holders and favor people that you may define as rich becoming more wealthy. And primarily, we've seen this in the last 10 to 12 years, and really starting after the last big '08 crash, the Great Recession. The Fed funds rate, which is also known as the base interest rate of the whole economy, fell down to zero. And it stayed virtually at zero until they gradually started raising over time, and then plateauing off again until the Rona came up and made them cut again down to zero. So what happens when interest rates are at virtually zero? Well, the cost of borrowing money to funnel asset growth is lower, which funnels what? You guessed it, more asset growth. And you've also seen the 30-year mortgage. This is the line in red here. And this isn't a candlestick chart like we showed in one of my last videos. This is just a normal chart that fluctuates up and down. No candlesticks involved here. But the 30-year mortgage rate started falling gradually from 6%. You notice it lagged behind the drop in the Fed funds rate. And it started to fall here, then started to come back up a little bit, and then started to fall more precipitously when the Rona hit. And now, if we factor in 2021 in this chart, we'll notice that mortgage rates are actually at all-time lows, which again funnel what? More asset growth and appreciation. Just look at the housing market over the last year and a half. Housing values are at all-time highs. And that's because of this. And again, the policies and the system overall favor asset holders. And to further build on that, point number 3, tax policy disincentivizes asset churning, instead incentivizing holding for long-term capital growth. And this is really noticed when people hold on to their assets for a long time instead of selling, because, and this is what the tax code incentivizes, when you own stocks or any kind of investments and you sell them, you're going to pay a capital gain. So to avoid that, people that hold assets very often try to hold them for longer periods of time to avoid that taxation. And then that kind of leads to a snowball effect where the asset values grow and they appear to grow virtually tax-free for many, many years. Buying and selling asset churn of assets leads to more short-term taxation. That's what I define as asset churn. And that's a disincentive, like I was just saying. Now, given points 1 and 2 that I made, the cycle causes asset owners to own even more assets, which results in them becoming richer. And we use rich in quotation marks because it's somewhat of a loose definition. But I think we've come to a general consensus in this presentation that being rich involves some kind of asset ownership. So those who don't own assets are at the whims of whatever worth they can exchange their time for. And sadly, wages often do not keep up with the average inflation rate we've discussed in this presentation and prior ones. I should have included that cash losing value slide again. That'd be a trifecta. And again, all of this is no more evident than in the past 1 to 2 years. According to this chart from the Federal Reserve, over the last 4.5 years, the asset allocation among the top 1%, 90 to 99 percentile, 50 to 90th percentiles, and then the bottom 50%. And this is so profound in this chart. The bottom 50%, which only have their time to exchange because they don't own assets, they barely see an increase at all. But the 50th to 90th percentiles, which may be the middle class that's starting to come into some asset ownership, they see an appreciation in their value. And then the 90th to 99th percentiles, which is also the top 10%, they see a more noticeable appreciation in values. But the top 1% that we hear about a lot in the media, look at that. Especially since what happened here, the Rona, just accelerated the growth and the appreciation in this top bracket here. And that last part, we'll get into that more in the bonus content that I'm going to have for you. I'm actually going to open up this site, which I have open here. I'm going to pull it up and show you the actual numbers. And it's really profound. So how can you offset this? Well, primarily, start saving, investing, and owning assets as soon as possible. That's so important. It takes starting, setting the right habits, and staying committed. My recommendations from this video: reduce your expenses, reduce your debt, save 25 to 50% of your income if you really want to be in this group, and funnel those savings into what I call asset vehicles, real estate and investments. And the bonus content is coming. So if you followed this video for this long, you definitely deserve some bonus content, like I hinted to before I went over this slide here. Before I get into the bonus content, please remember again to like, comment, and subscribe to the channel. And now with that, I'm going to show you what I was referring to here in this slide. This chart, we want to see more of a breakout of this. So if I go here, some nice vacation pics there. Not this one, not this one. Of course, it's the first one. So, and when I put this in the slide, I didn't quite capture this. But you'll notice here as I hover over this, the change. You can see, especially for the top 3 brackets here, this is in trillions of dollars, how this is going up and up and up. And then here, if you take Q1 2020, 31.23 trillion for the top 1%, 90 to 99%, 40.28 trillion. Hopefully I haven't lost anybody yet. I know these numbers aren't exactly too fun, but it's important to understand this concept here. And you're going to see a precipitous uptick, especially in these top 3 brackets. Why? Because they own assets. That's the key takeaway from this video. Now watch this. This is going to make your head spin. We got to go up. Just from Q1 to Q2, $3 trillion from this top bracket right here because they own assets. That's why. That's the secret, so to speak. Q3, another $2 trillion. These are quarters, not even full years. Profound. And then by Q4, almost $40 trillion. And then by Q1 of this year, 41.52 trillion, 48.8 trillion. Wow, that bracket actually saw more growth. And again, this is because these are the groups that have the most investments. They hold the most stocks. They hold the most ETFs. They hold the most indexed funds. They have their IRAs, their retirements, their 401ks, and they have real estate. They have, what do all those things have in common? They appreciate in value over time significantly because of the policies that the system promotes. I mean, that's profound. Look at that. So in just a year, significant increase. So that's why asset ownership is how the rich seem to become richer. And with that, thank you all so much for watching this video and for staying tuned this long.